Most investors lose money in the stock market. They buy stocks based on tips, hunches, or news headlines, then watch helplessly as their portfolios decline. But what if there was a proven system that could identify winning stocks before they make their biggest moves? What if you could learn the exact same method used by some of the most successful investors in history? William O'Neill spent decades analysing every major stock market winner dating back to the 1880s. He studied what made these stocks different. What patterns did they share before their massive price advances? His research led to a revolutionary discovery. Virtually all winning stocks displayed 7 specific characteristics before their major moves. He called this system CAN-SLIM, and it has helped thousands of investors achieve extraordinary returns. The CAN-SLIM method represents a powerful combination of fundamental and technical analysis. Each letter stands for a crucial factor that separates winning stocks from losers. When all 7 factors align, you have identified a potential market leader ready to deliver exceptional gains. C stands for current quarterly earnings. According to O'Neill's research, 3 out of 4 winning stocks showed earnings increases of at least 70% in their most recent quarter, before beginning their major price moves. This is not just any earnings growth. This is explosive, accelerating earnings that signal something fundamental has changed in the company's business. The earnings must be real, not one-time gains or accounting adjustments. Compare the current quarter to the same quarter from the previous year, not the prior quarter. To avoid seasonal distortions, it represents annual earnings growth. While quarterly earnings show current momentum, annual earnings reveal sustained excellence. O'Neill found that winning stocks averaged 25% annual earnings growth over the past 3 years. But here is what most investors miss. The rate of growth should be accelerating. A company growing at 15%, then 20%, then 30% is more attractive than one growing at a steady 25%. This acceleration indicates expanding market opportunity and improving competitive position. N stands for new. This could mean a new product, new service, new management, or simply a new high in the stock price. O'Neill discovered that 95% of the greatest winners in stock market history had something new driving their growth. Apple had the iPhone, Google had a new approach to search, Netflix had streaming. The new element creates the catalyst that propels earnings growth and attracts institutional investors. Interestingly, many investors fear buying stocks at new highs, yet O'Neill's research proves that stocks making new highs are more likely to go higher. S represents supply and demand. This refers to shares outstanding and trading volume. Winning stocks typically have a smaller supply of shares available, often under 25 million shares in the float. When demand increases for a limited supply, prices rise more dramatically. But the real key is volume. When a stock breaks out of a proper base pattern, volume should surge at least 50% above average. This confirms that large institutions are accumulating shares. Without this volume confirmation, the breakout is suspect. L stands for leader or laggard. In any market cycle, certain stocks lead while others lag. O'Neill insists you must buy the leaders and avoid the laggards. How do you identify leaders? Use the relative strength rating, which compares a stock's price performance to all other stocks. Leaders have ratings above 80, meaning they are outperforming 80% of the market. Many investors make the fatal mistake of buying laggards because they look cheap, but stocks that look cheap usually get cheaper, while leaders continue leading. I represents institutional sponsorship. Mutual funds, pension funds, and other institutions drive stock prices through their massive buying power. A stock needs some institutional ownership to fuel a major advance, but not too much. If every institution already owns it, who is left to buy? O'Neill found the sweet spot is 3 to 10 institutional owners, with recent quarters showing increasing institutional accumulation. Check if top-performing funds are buying. Their professional research and resources give them an edge in identifying winners early. M stands for market direction. This may be the most important factor of all. 3 out of 4 stocks follow the general market trend. Even the best stocks struggle in a declining market. O'Neill teaches investors to track daily market indices and volume. Look for follow-through days, which occur when a major index rises substantially on higher volume after a market correction. This signals a new uptrend is beginning. Conversely, distribution days, where indices fall on heavy volume, warn of potential market tops. But knowing what to buy is only half the equation. You must also know when to buy. O'Neill identified specific chart patterns that winning stocks form before their major advances. The cup with handle pattern is his favourite. Picture a coffee cup from the side. The stock declines, forms a rounded bottom over several months, rises back near its old high, pulls back slightly to form the handle, then breaks out on heavy volume. This pattern can take 3 to 6 months to form properly. The flat base is another powerful pattern, where a stock moves sideways for at least 5 weeks after a previous advance. The double bottom pattern looks like the letter J, with the second bottom slightly higher than the first. Each pattern has specific rules for depth of correction, length of formation, and volume characteristics. Buying at the exact right moment, called the pivot point or buy point, is crucial for success. Now, here is where most investors fail catastrophically. They do not have sell rules. O'Neill is ruthless about cutting losses. If a stock falls 7 to 8% below your purchase price, sell it immediately. No exceptions. This rule alone will save you from devastating losses. Think about it mathematically. A 50% loss requires a 100% gain just to break even, but a 7% loss only needs an 8% gain to recover. O'Neill also provides clear rules for selling winners. Take profits when stocks rise 20 to 25% from the proper buy point. In a bear market, consider selling at 10 to 15% gains. If a stock rises 20% in less than 3 weeks from the breakout, hold it for at least 8 weeks. These exceptional movers often become the biggest winners. This brings me to wonder, which aspect of the CanSlim system do you think would be most challenging to implement in your own investing? Let us explore the final crucial elements that bring everything together. Position sizing and portfolio management determine long-term success. O'Neill recommends concentrating your portfolio in your best ideas. Own no more than 5 to 7 stocks. This allows you to properly research and monitor each position. Diversification is protection against ignorance, but concentration builds wealth when combined with knowledge and discipline. The timing of your purchases matters enormously. Do not buy all at once. Start with a half position. If the stock moves up from the buy point, add to your position. If it declines, you have limited your exposure. This technique, called pyramiding, ensures you have the most money invested in your biggest winners and the least in losers. Market timing affects everything. During confirmed uptrends, you can be fully invested and even use some margin. During corrections, raise cash and wait for the next follow-through day. In bear markets, stay mostly in cash. The market will tell you what to do if you learn to listen. O'Neill emphasizes that successful investing requires continuous learning. Study the daily charts of leading stocks. Read Investors Business Daily, which O'Neill created specifically to provide CanSlim data. Analyze your mistakes to avoid repeating them. Keep a trading journal documenting why you bought, where you bought, and why you sold. The psychological aspects prove most difficult for investors. You must buy when stocks look expensive and sell when they look cheap. You must cut losses quickly while letting winners run. You must overcome fear when buying breakouts and greed when taking profits. These behaviors feel unnatural because they oppose human instinct. The CanSlim method is not about picking stocks that might go up. It is about identifying the very best companies at the exact moment when institutional investors are beginning to accumulate shares aggressively. When earnings growth accelerates, when new products capture market share, when supply and demand dynamics align perfectly, explosive gains become not just possible, but probable. The evidence is overwhelming. O'Neill used this system to transform $500 into $200,000 in just 26 months. His firm's research shows that CanSlim stocks outperformed the market by 5 to 1 over multiple decades. Individual investors using this method have achieved returns that professional money managers only dream about. The final takeaway is this: stock market success is not random. Winners share specific, identifiable characteristics that appear repeatedly throughout market history. Master the CanSlim criteria, buy at the precise pivot points, cut losses religiously at 7%, and let your winners run with proper profit-taking rules. This systematic approach removes emotion and replaces gambling with calculated investing based on proven historical patterns. If you found this summary valuable, please subscribe to our channel where we upload new book summaries every single day to help you learn faster and achieve more. And if this information helped you understand the stock market better, please hit the like button. Your feedback helps us know which summaries provide the most value for your learning journey.